Hello and welcome to Class 8 Personal Finance. My name is Garrett and I am not an investing professional. I'm just a DIY investing enthusiast. And in this video, I want to talk about the UPS Teamsters 401k plan. I had a couple of friends ask me to do this, and so I'm going off the plan I had about investment advice. And instead, we're going to talk about the 401k plan itself. This is my disclaimer. Don't sue me. Also, in this particular video, don't go after my employer, don't go after my union, because this is just my own opinion about the 401k plan that I happen to be in as a result of being a part of this company and a part of this union. I am not representing either of these organizations in this video. Please don't go after them. Now, that said, let's talk about the plan. On this page, Teamster UPS 401k plan.com, you have a set of documents. And so we're just going to go through some of these documents here to talk about just the basic um, contribution stuff. You can contribute up to $20,500 a year. It comes out of your payroll. $6,500 extra if you are 50 or older. There are different types of contributions that you can make. The two major ones are pre-tax contributions and Roth contributions. 95% of the time, or for 95% of participants, Roth is probably best. And the reason for that is we get a pension that's going to come with taxable income. When you have taxable income, you probably would rather receive tax free income on top of that so that you don't send your tax bracket to the moon. So use Roth contributions and pay your taxes on that income now rather than paying it on more income later. The thing to be careful with here is do not mess with after tax contributions unless you really know what you're doing. There is a way potentially that you can take those after tax contributions and send them over to a Roth IRA. I've seen one person online talk about doing this, and that was it. And I'm not sure if it worked. I asked the question once, and no one was really sure. Don't count on that part. I would love to know if someone's really pulled it off reliably. But until I know that, I cannot recommend after tax contributions. What I have seen is folks making after tax contributions thinking that they were Roth and then figuring out that they're not. And there were some bad tax implications going on there. Stick with Roth contributions. In terms of how much you want to contribute, I would say start at 10% and go from there. But this video is not about how much you need to contribute, how much you need to have at the final end. There are provisions in our plan about hardship loans and withdrawals. I'm going to summarize this here in my earlier takes. I went way too long on this. If you're making Roth contributions, you can't use loans or withdrawals. There's language in here that says excluding your self-managed account in any portion of your Roth 401k account. Use tax shelters for what they're for. The tax shelters of 401ks and IRAs are for retirement, not for your house. Sure, there's an exception in there, but I say save for your house in a taxable account, not in your IRA, certainly not in your UPS Teamsters 401k with Roth contributions, because you won't be able to take the money out at all anyway. Going on from there, let's talk about fees. And I want to point out, for one, there is a $20.50 administrative fee annually. So and that comes out monthly. So if you look at your account and you see that they took out $1.71 in fees, which happens to be roughly 1/12 of $20.50. Is it exactly? I don't know. I don't feel like doing math right now, but you get the idea. Um, there is a monthly fee that gets assessed from your fund, so don't freak out about that. I'm also going to point out this table right here because it does a good job of illustrating what the fees are. These are the annual fees per $10,000 invested. Pretty much with the exception of the stable value fund, these are all very, very, very low cost. Let's continue on, and I want to um, let's see if I can get to the portion that I should be at because I should have had it loaded already. You can tell, perhaps you can tell that this is a second take, and I'm trying to get through the basic stuff really quickly. And I'm actually going to skip through the stable value fund here, and I'm going to focus more on the accumulators. The government short term investment fund, I will cover. Let's go into that. I'm going to close a bunch of tabs here and go into the government short term investment fund. And I'll use this partly as an illustrative tool because it's that name tells us two different things about how bonds work. I have a separate video about bonds and how they're priced and that kind of thing that you could go into, but here's what I want to zoom in on. This is a style box right here. Do I have short term showing in the video? I do now. Okay. So you have these two axes. You have high grade, medium grade, and low grade. And then you have the y-axis is long-term, intermediate term, and short term. High grade would be, for example, the US government, because they can literally print out the money that they owe you for that kind of thing. There's also AAA rated corporate bonds would be classified under high grade. So you can see here under the button there that this is all high grade, and that's because this is a government short-term securities fund. You can also see here long-term, intermediate term, and short-term. This is not merely a measure of maturity, like when the bonds in there mature. It is also a measure of interest rate risk, or another way you could term that is duration. Let me illustrate interest rate risk for a moment. Suppose that you buy a bond from Microsoft, a very high quality company, and they're going to pay you 5% a year for the next 20 years for this bond that costs a certain amount. And hey, that's great. The next day, Jay Powell, the Fed chairman, wakes up and goes, "Oh crap, we need to raise interest rates." And we're raising interest rates by 3%, and the news breaks, and it causes a recession, etc. And you're holding this 5% bond from Microsoft that you just bought, and you look on the market after this rate raise, and you see that Microsoft is selling the very same face value of a bond for 8% for the same price out in the market. And you've been left holding the bag. What's your bond worth? A lot less, because no one wants your 5% bond for that same price. Somebody might want it, but it's going to be for a much lower price. The price of the bond that you're holding in your hand went down a lot because it gets paid off in 20 years. Now, if it were being paid off in 20 days, you wouldn't care so much. It's like, well, okay, I'll wait for it to mature and I'll just go buy another one or something like that. That's what we mean by long-term, intermediate term, and short term. Not only is it in terms of when the bond matures, but also the interest rate risk associated with it. And to take more risk, that's also generally going to come with higher rates. That's why I wanted to go into this, because a government short-term investment fund is a very, very safe fund. It's all US government stuff, and this is all within 90 days of maturity. This is a great fund if you're using your 401k as a savings account, which I hope you're not. It could be part of your fund if you're a retiree, something like that, because you've got to keep a certain portion really, really safe, and you already passed 59 and a half, and you perhaps are using it as an emergency fund or something like that. That makes sense if you're a retiree. It doesn't make sense if you're my age, I'm 37, or any younger, and you're actually trying to accumulate and make this thing grow interest. So if you're a retiree, hey, maybe go for it. Use that as part of your allocation. My dog needs to stop scratching inside her kennel. Okay. Thanks, dog. I hope that's not coming through. That's really annoying. So let's talk about this next one, the bond market index fund. I don't want to go too much into the things that I don't like about this, but within the 401k, because we have limited options, this should be your core bond fund. Your typical asset allocations are going to have stocks and bonds. This should pretty much be the entire bond side unless you're trying to do something really, really weird. And so if you look at the style box here, notice the little button changed. It is showing. So you have still high grade, but now intermediate term. And that high grade is partly a result, well, it's really the result of the fact that a lot of this is treasury, is still 40.55%. This 30.25% seems to be mortgage backed securities. And some mortgage backed securities are, in a sense, government backed because they're issued by federal agencies. You're talking about Fannie Mae, Freddie Mac, Ginnie Mae. And then so you have your credit quality breakdown, and it's 74% triple A rated. That's what's putting this on the left. And then you can see allocation by maturity. You can see you really don't have a majority in any of these. It's all these different ranges of bonds. So this should be your general bond fund. Now, in a Roth IRA, I would tell you to do, I'll potentially tell you to do something different, but within the 401k, we're kind of stuck with this one, and it does the trick. The balanced fund, I'm going to spend like 10 seconds on this. It's 50% S&P 500 and 50% that bond index that we just talked about. And that's it. You don't need it. If you actually wanted to do that, you could just plug in 50/50 on the website and do that. So why do you need this? Why does this exist? I don't know. S&P 500 equity index fund. This should be basically the core US fund in your 401k. The S&P 500 is an index that tracks. Here's how this gets worded. The fund invests in all 500 large capitalization stocks in the S&P 500 index in proportion to their weighting in the index. That doesn't really explain it a whole lot. It's 500 of the largest capitalization, largest companies that are publicly traded. And so you have these companies here that you've actually heard of: Apple, Microsoft, Amazon, Alphabet, Tesla, etc. The thing you kind of need to know about this is that it's about 80% of the overall US market. In fact, let me deviate from my plan here. Sometimes that's not a good idea, sometimes it is. But I'm going to show you kind of the universe of indexes here. Should I mess with the interface here? This is okay. So note the S&P 500 index right here if you can see it. Hopefully you can zoom in because it's not going to let me zoom in all that easily. This says S&P 500 index here. That's one of the indexes we have a fund to track. We have S&P Midcap 400 index right here. And you're like, oh, these boxes, they're sort of the same size. And then our third US fund is actually the Russell 2000, which is over here. So the idea is if you want to track as much of the market as possible, you would say, okay, I want the S&P 500 index, I want Midcap 400, and I want Russell 2000. I want to put these in proportion, right? Well, pay attention to this a little bit more. According to this chart from Vanguard, and it's a historical chart, but it works. The S&P 500 is 82% of market cap. 82% of this whole universe of 4,000 stocks or whatever it is now. The S&P Midcap 400 is 7%, and the Russell 2000 is 8%. So if you do the math, what you're talking about is if you want to try to track the entire market just kind of all at once, you would say you would want 80% S&P 500, 10% S&P 400, and 10% Russell 2000. And that's one way you could do that. So you go to the, that's not what I want. I think I wanted, that's balanced. Come on, O'Hara, do better. So you have the S&P 500 here, which is your large capitalization stocks. You have your S&P 400 mid-cap fund. And there's some things you can note here. Note that I just went back to S&P 500. The average size of the company within here is $465.8 billion, dollars, whereas the average size of the companies in the S&P 400 is only $6 billion. Hopefully that illustrates it a little better. And then take a note, among these top 10 securities, you probably haven't heard of more than one of them, if even that. Um, I've heard of Fair Isaac. Steel Dynamics, probably not. Target Resources, I might have heard of, kind of thing. Um, that kind of thing. But you've heard of Apple. You've heard of Microsoft. You heard of Alphabet slash Google. And then there's a Russell 2000 fund, which is this. And then the average price, average size of the company here is only $2.5 billion. This little button's in the lower end of the style box. So S&P 500 was here. S&P 400 was here. Russell 2000 was right here. How's my time? I'm doing okay. And then you probably haven't heard of any of these companies. I don't think I've heard of any of these companies. Shockwave Medical. Oh yeah, I've heard of them. No, I haven't. It's probably just my brain messing with me. That kind of thing. So you could go 80-10-10 among your US stocks and then have your international index fund. And let's talk about that international one for just a moment. If you live in 401k world and you have no other investment accounts, then the details of this one might not matter all that much, but I'll point them out. It tracks an index called the MSCI EAFE index, EAFE, and that stands for Europe, Australasia, Far East. So we're already excluding some parts of the world. We're excluding the US because it's an international index. We're excluding all of the Americas, and what this doesn't tell you is it excludes emerging markets. Generally, the international markets are split into developed markets and emerging markets and frontier markets. This is only a developed markets fund. And so there are only two developed markets in the Americas. And those are Canada and the United States. Because this is the Europe, Australasia, Far East Index, oddly enough, it actually excludes Canada. It excludes emerging markets, companies like China and Taiwan and Brazil. It also excludes South Korea, because according to MSCI, South Korea is an emerging markets country. Even though a competitor, their major competitor, FTSE, that's spelled FTSE, considers South Korea to be a developed markets country. So go figure. Now, that said, all that is to say, if you live in the 401k world, that's really not going to matter because there's not a whole lot you can do about it unless you go through the self-managed account, which I'm not going to talk about because it's just going to be too complex. But you still have a whole host of international markets here. If you want to know more about that, I'm gonna go into some ETF equivalents so that I can show you how to track statistics and things like that. And then finally, let's talk about this Reit index fund. And I've had some troubles recording things tonight, and I had a major outtake when I opened this up because it doesn't actually show the fact sheet. There's no fact sheet for the Reit index fund. So I'm just going to tell you about it mostly from memory, but I'll pull up the Morningstar equivalent of this fund. Not quite equivalent, but close enough right here. And this ticker symbol is VNQ. And you can see some of the companies that are included here. And this is probably what the major ones that are in this US Reit fund. There probably aren't too many differences. Prologis. If you are a feeder driver, and for those non-UPS people, that means driving 18-wheelers, you have probably been to a Prologis facility. At least if you've done customer pickups / TDP, is sometimes called, because Prologis is a warehouse REIT. Let's back up a little bit. REIT stands for Real Estate Investment Trust, REIT. And these are companies that primarily own and operate income-producing real estate, such as apartment buildings, office buildings, warehouses, shopping centers. In order to be a REIT in the United States, a company must distribute 90% of its taxable income to its investors in the form of dividends. And that entitles them to a special tax treatment. And on top of that, by the way, if it's in your 401k, you don't have to worry about tax treatment because, you're not going to pay taxes on it. Um, you're not going to pay taxes on the dividends. That is, if you do the pre-tax thing, you're going to have to pay taxes on the way out, but it's just what you take on the way out, not persistent dividend income. That's what I'm talking about. If you already own an S&P 500 index fund, however, can we find that page quickly? S&P 500, that's balanced. If you own an S&P 500 index fund, note right here, real estate, 2.92%. So you already own REITs if you own an S&P 500 index fund. So the question that comes up then is, why is there a separate REIT fund in our 401k? Why would you want to add more? There is an argument among experts as to whether REITs constitute not merely a separate sector among stocks, but an actual separate, distinct asset class. Like you would say, these are stocks, these are bonds, and then these are REITs, and they're a separate thing, and they're not stocks, and they're not bonds. They're definitely not bonds, but are they stocks? That's the argument. And a lot of the reason for this is that they have a low correlation with stocks. Stocks and other and non-REIT stocks and REITs don't tend to go with each other. So the argument goes you should hold a separate REIT fund in addition to your normal stocks. And I used to do this myself. I actually held 10% of my stocks as REITs. But I think now that the arguments against a separate REIT allocation are stronger. Primarily, REITs come with a separate idiosyncratic risk that comes from being in the real estate sector. And that kind of risk doesn't come with an expected return. On top of that, quite a lot of us own homes. Yeah. And that might be enough real estate risk for your taste, and you don't want to think of anymore. There are also better tilts to pursue than real estate if you must pursue a tilt, if you must go farther than a 3 or 4 fund portfolio, and you're like, okay, I want to do this special thing on top of it to kind of give it a little juice or something. There are better ways to do that than using a real estate tilt. So for those reasons, I don't recommend going into REITs as part of your allocation. So those are the funds that are not target date funds. Let's talk about target date funds for a moment because I think these get poo-pooed on quite a lot, and I don't really think the poo-poo party is fair. So take a look again at these fees. So you look at US large cap, mid cap, small cap, international. So these are the 4 funds that I would say you should use on the stock side. And then you have the bond market fund here as your bond side. I really wish I should have just put this on a spreadsheet and then I could just erase the rest of them and make it easier to read, but that is what it is. So on the large cap side, you have $1.88 per $10,000 invested. I'm going to give you some jargon here, by the way. When we talk about fees, let's find something that's easier here. So the total expenses here it says 0.0188%. Another way to say this is in basis points, and a basis point is 0.01%. So in other words, this we would call 1.88 basis points. Now that's a lot easier when the numbers there aren't so many decimal places. So for example, this one right here, 0.04% would just be called 4 basis points. And we can even abbreviate basis point, just call it BIPS, BPS, BIPS. And so you look at a fact sheet like this one, and in fact, they decided to just stick it in the BIPS right there. Or you could just say basis point, and that's fine. And so when you look at the fact sheets, just note that BPS, BIPS, is 0.01%. So this would be 0.04% for the investment fee in this government short-term fund. By the way, these fact sheets are updated more recently than the fee sheet that we were just talking about. So you might see some discrepancies, but the fees are low. Don't sweat that part. Now, you have these fees here from the stock funds, and it so happens that this calculation here is in bips or basis points. So you have 1.88 basis points here for the S&P 500, 2.58 for mid cap, 4.18 for small cap, which makes sense because you're going to have more liquidity issues with smaller stocks. Also makes sense here to have 8.48 bips for the international fund. The target date funds all are 6.78 bips, at least according to this, and at least for now. In fact, let me look one up just to see if that had anything has changed there. So we got 5.50 there and 0.28 there. 5.50, 0.28. Does that make sense? Yeah, so the fees are the same, it would appear. So the reason why these Bright Horizon target date funds get poo-pooed on, in a sense, is because the fees are higher. And there's no denying that the fees are higher. Let me mount a defense of these target date funds by pointing out a series of funds that I recently said are good on this channel. Let me type it in, Freedom Index. I'm going to use 2050 because I'm 37 and I turned 65 in 2050. So this is just a normal mutual fund that you can't get within the 401k unless you do the whole self-managed account thing, which you probably shouldn't. But you can still get this in a Roth IRA. And note the expense ratio right here. So this is their statement, Fidelity statement of fees right here. 0.12% or 12 bips. In other words, almost twice as much as these Bright Horizon target date funds. So yes, they are more expensive. Why should you use a target date fund? Well, if you're the kind of investor who's already gone through this video and you've quit, then you're not listening to me or something. Or let's say that you think you should have quit. Your eyes are glazing over. You'll just let this thing run while you're washing your dishes or something like that. But you're like, oh, this is too much for me. Use a target date fund. How's a target date fund will put you in something reasonable for your retirement date, assuming you choose the right fund for the date when you plan to retire, and it'll give you a reasonable asset allocation going all the way. And if that's what you need to do to stay disciplined, then do it. If furthermore, it's not merely, okay, I don't know how to build an asset allocation, which is what I'm about to show, but behavioral error. Like you see something on the market and you're like, what do I do with my asset allocation? How do I do these percentages? And you're concerned and you think that behavior could affect your investments negatively, and they really can. Money really messes with the brain. It really does. Then you might want to just go with the target date fund and then let the target date fund mess with the allocation. And they're going to respond to the market merely by reallocating back to where it should be according to the plan and not try to time the market or some nonsense like that. I like target date funds and I like them a lot. If you are the kind of person who is literally dependent on Dave Ramsey's advice, like you're capable of mounting $10,000 in credit card debt and you barely clawed out and you're trying not to go back or whatnot, you might be the kind of person to really benefit from a target date fund. And I'm not saying that to ding anyone's character or honor or whatnot. It's simply choosing the option that is best for you because personal finance is personal. So don't ding target date funds. I don't like it when they get dinged. Could you do better by making your own asset allocation? Yeah. In fact, let's show you how to do that. I mentioned earlier that I don't like the Russell 2000, but I like some of the others. Let's build an asset allocation. And I'm just gonna what I should have done is open up a tab on here and at least preset it. But let's say that you're doing this for the first time and you're gonna build your own spreadsheet. So let's just do this. S&P 500 right here. S&P mid cap 400. We're gonna have international, and we're gonna have bond. Just 4. 4 is all you need in this. I'm going to avoid the Russell 2000 again. I don't like how there's too many unprofitable companies in there. I think it's counterproductive. There are better ways to get exposure to small cap if you want to do that. I have some ideas in other videos on this channel. Let's get these bigger. Let's say 24 right there. Will that work? Yeah, there's enough room there. Okay. So the first thing you need to do when you're deciding an asset allocation is to figure out your percentage of stocks versus bonds. These 3 funds right here, I'm just going to mark them in green for stocks. And for bonds, I'm going to make them whatever that light manila brown is or whatnot. These are stocks, these are bonds. You need to figure out what percentage you needed stocks, what percentage you needed bonds. And there's a few ways to do that. One is by a rule of thumb. For example, age minus 20 is one I kind of like. So if you're 25 years old, an age minus 20 in bonds rule would mean that you're in 5%. I gotta just make things bigger, guys. There's like, not like that. How about that? There we go. You would be 5% in bonds, and let's merge these together, and you would be 95% in stocks. Another way you could do this is simply to plagiarize that Bright Horizon fund. There's some smart people figuring out these target date funds. Here it is for my age. According to these guys, at my age, I should be at 89% equities and 11% fixed income. I've made a different decision for different reasons based on my financial situation. But if you're not thinking that hard, you could just use a rule of thumb like age minus 20. I've heard 120 minus your age in stocks, for example. That's another one. Let's just go with age minus 20 to be simple. And let's say that we're talking about a 30-year-old. So if for a 30-year-old, 30 minus 20 is 10. So let's just say 10% in bonds and 90% in stocks. Let's tell you what, I'm going to bring this out a little more, and I'm going to make some borders here. Make this better. Is my audio still working? I think it is. All right. And we're going to center these. 90% stocks, 10% bonds. Okay, what's our next decision? Our next decision is to figure out the ratio between US stocks and international stocks. So these two are our US stock funds, the S&P 500 and the S&P Midcap 400. And then international is international. There's a few ways to think about this. Some folks will actually say you need no international at all. And these are folks with big names who really, really have deserve respect. John C. Bogle, the founder of Vanguard, the guy who made the S&P 500 index fund available to the masses, said all you need is the US. Why? Because the US funds are already exposed to international stuff. Can I find the S&P 500 here? I can. Where does Apple sell a whole bunch of stuff? Well, everywhere. Where does Microsoft sell a whole bunch of stuff? Everywhere. Where does Apple manufacture their phones? Not here, China. That kind of thing. The whole idea with that philosophy is that, hey, you don't need international exposure because there's international exposure to all these American companies in here anyway. And here's my response to that. All these international companies, let's find them. International companies, Nestle, Rush Holding, AstraZeneca, Shell, You've heard of a lot of these. Um, Toyota, they do business here. So why wouldn't you diversify? Um, are there greater fees associated with the international? Yes, I think it's worth it to have the diversification. Um, and on top of that, you get some currency diversification benefit there as well. So I'm going to say yes to international diversification, partly mostly because I agree with it, but also because we kind of need it in order to actually provide the illustration. So, what should we do between these two? Well, um, two ways to think about that I already mentioned. One is that the US is already 60% of the world stock market. And if you exclude the emerging markets out of the international side, it comes out to about 65-35. I'm going to say 60-40 because it makes the math easier. You might choose 65-35. Some will say, hey, I want just a little bit of dollop international, 20% international. And that would work too. I like 60-40. So that's what I'm going to do. So we're going to say, I'm going to let the spreadsheet do the math for us. So I have equals 0.90 for the 90%. And I'm going to multiply that by 0.60 right here. And that's going to bring us out to 54%. Easy enough. And we're going to make this a percentage right there. I'm going to kill the decimal points because they're zeros. Now, this is the same way. I could just go 90 minus 54 and do that, or I can do the math again and make sure that it makes sense. So 0.90 times 0.40, which is 36%. And we're going to reject that autofill because Google Sheets doesn't know what I'm talking about. So 60% of 90%, let me put a percentage here just to make it make more sense. 60% of 90% is 54%. 40% of 90% is 36%. So we've got some percentages going on. Bonds, well, 100% of 10% is 10%. So we're just going to transfer 10% over here for now, and we're going to vertically. I thought I already vertically centered everything, but let's just do that. Okay, now all we have to do is figure out the percentage between these two. You could argue that you just don't need that S&P 400 fund in the first place, and there's actually reason for that. If you compare an S&P 500 index fund to a total market U.S. fund that includes what's in the S&P 400 and what's in the Russell 2000, they perform roughly the same. I like to have a little bit of tilt towards mid cap in this context, so I suggest 75-25. But you could totally justify just 100% S&P 500 and just say, hey, 54% S&P 500, 36% international, 10% bond, done. Or you could just tilt some more to mid cap. If you were going by just how much mid cap is in the market, you could go 90-10 or something like that. I suggest 75-25. I know that sounds a little aggressive, but it also makes up as a proxy for what's in the Russell 2000 in a sense. So here's how I'm going to put it. 54%, 0.54 times 0.75 is 40.5%. So make this that and kill one of the decimal points. And then same way over here. 0.54, 54% times 0.25 equals 13.5. Easy enough. And then change the format, 36% here and 10% here. And if you need any help lining all this stuff up, then you just do that right there. And so there is a pretty easy way to figure out your asset allocation. If you can repeat that process for your age based upon how you want to figure out stocks versus bonds, how you want to figure out US versus international, and how you want to figure out between 2 or even 3 US funds, you know how to build a portfolio. And I'm not saying you're going to beat the Bright Horizon, in terms of performance, because you're going to come out with different numbers than Bright Horizon, and it's going to be based on market factors and all that. But you'll be able to beat Bright Horizon on fees, and you'll have control over what's going on. You'll be able to tailor this based upon your risk tolerance and your need for the money to grow or to stay safe. So that's how you do that. So let's summarize here with the 401k plan. I can go back to the basic stuff. So you have a $20,500 annual contribution limit that's going to go up. You have catch-up contributions after you are 50 or older. 95% of the time, you should be in Roth contributions, but there are exceptions to that. Don't count on loans with withdrawals. Your emergency fund should come from an actual emergency fund. And oh, by the way, we have a contract expiring at the end of July next year. You should have a strike fund because strike pay is worth diddly squat, and you should not count on being able to pull money out of your 401k if a strike goes long. You have a whole list of investments that you can use here, and the primary ones are S&P 500, S&P 400. I say skip the Russell 2000 completely. International is good, and the bond market. Those are the ones you should really pay attention to if you're not using a Bright Horizon fund. But don't poo-poo the Bright Horizon funds, because they are useful tools for the people who need them. That is UPS Teamsters 401k 101. And I made it without my microphone dying. My back kind of hurts. My voice kind of hurts because this isn't my first take, but I think this worked, and I'm going to stick with it. Thank you so very much for watching. If you want to use the spreadsheet, by the way, this is a shared spreadsheet. I will have the link. I have the link to the shared spreadsheet in the description of every video on this channel. This is not going to be called Sheet 13. I'm going to call it something else. But you click on all sheets right here in Google Sheets, and you've got all this different stuff here from the different videos that I've done. So please take advantage of it, including, you know what? There's one thing that I didn't talk about, which is this huge complex thing here where I list out ETFs to equate with things that you have in your 401k. So let's say that you have your 401k and you're like, you know what? I need stuff in my IRA as well. Can I explain this out? In fact, let me just kill my face for a moment. Can I do that and still talk? Do I have audio? I have audio. Yay, without my face. So over here, we have the UPS Teamsters 401k funds, including the funds that we don't really like. Right here, we have close equivalents, basically for stats. So if you go to portfoliovisualizer.com, you can see the past performance of funds that are like the ones we have in our 401k. You can't just type in UPS Teamsters in there and expect them to have it. They won't. But you can type in funds that do exist that you can look at. I also put in recommended alternatives. Let's say that you're investing in both a 401k and a Roth IRA or something like that. I put in some recommended alternatives and how to use them. So it's easy enough to build a 3 or 4 fund portfolio within your 401k account. But it's also easy to do this within a brokerage account or a mutual fund account or whatnot, and pick the funds that you need and just construct the same portfolio. And that way, you don't have to worry about trying to mix and trying to figure out what's in every asset class or something like that. Although you could do that, and that's actually what I do. So please, feel free to make use of these resources. Leave me a comment if you have any questions. And by the way, that helps out the algorithm as well. So thank you so very much for watching if you made it to the end of this video. And have a good day. Happy investing, and I'll see you in the next video.